Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. It's Fed Watch. Let's just wait and see. For the second meeting in a row, the Federal Open Market Committee, FOMC, decided to keep rates unchanged, and that leaves the Fed funds trading range at 4.25% to 4.5%. And an important point to remember against the current investment backdrop is that this level for overnight money is still 100 basis points below where Fed funds was trading prior to the beginning of last autumn's rate cutting process. The decision to keep Fed funds at its current level came as little surprise, as the Fed appears to be just sitting back and waiting to see how the economic and inflation landscape unfolds, given the uncertainties that have arisen emanating from Washington, D.C. policy considerations. And that was definitely underscored in their policy statement. So needless to say, it's not just the Fed, but also the markets that are both in wait-and-see mode. And as I mentioned, the outcome of the March FOMC meeting was widely expected, and Powell and company had been clearly expressing their opinion that uncertainties surrounding topics such as tariffs, federal government cost cutting, had placed a cloud of sorts over the economic and inflation outlooks going forward. And as we sit here in the present time, it really doesn't look like that cloud's going to be removed anytime in the near future anyway. So that leaves us with, how did the key macro factors look heading into this period of uncertainty? And here in Q1, investors have seen official real GDP forecasts coming in all over the place. For example, the Atlanta Fed's GDP Now forecast has gone from being a plus 2.3 projection at the end of February to minus about 2.5%, owing to a surge in imports, which may have been just some front loading to avoid potential tariffs. We'll wait and see. Meanwhile, the New York Fed's own Nowcast, that's their measure for predicting growth, sees Q1 real GDP at plus 2.7% in its latest report. Now, recent economic data has provided somewhat of a mixed bag, but the labor markets still seem to be on relatively solid footing, and perhaps the most noteworthy on that front is the leading indicator, jobless claims. And the level of claims still remains about 100,000 below where it has resided before prior recessions over the last 40 years. Interestingly, prior to the Fed meeting, Chairman Powell had been stating that the economy was fine and doesn't need us to do anything. And therein lies the rub as far as the money and bond markets are concerned. In other words, incoming data is yesterday's news. And what's more important is what will future economic and inflation reports bring. And this is where the Fed appears to be at as well. That is data and DC policy dependent. And one other thing to make note of, the Fed did make an announcement and pull back the pace of balance sheet runoff in their quantitative tightening program, QT. They've already tapered their pace of balance sheet reduction, so it appears it is now a question of when, not if, to end it in the months ahead. And I think the bottom line here is, while market expectations for future rate cuts are more than likely going to continue to change, as we have seen on a regular basis, fixed income investors can position their bond portfolios to navigate this cloud of uncertainty by utilizing an active passive barbell strategy. So I'm going to end it there. Have a great rest of the week, everybody, and be well.